BDO Financial Reporting Update webinar. Sorry, just a moment, the slides are not moving. There we go. So on the agenda today, we have a bit of a year-end update where we'll be looking at key considerations for the next reporting season. And so we've got a slightly new format this time. You will have noticed on Zoom instead of WebEx. So if you have got any questions, then you can use the question and answer function that you'll find in the icons on the screen to raise those questions, and we'll try and either answer the questions during the webinar or get back to you afterwards. Now, if you do want us to be able to potentially get back to you, then please don't click the raise question anonymously feature there. The webinar will be recorded, and so that means that if there are any technical glitches, then hopefully you'll be able to listen to that later, but let's hope we don't have any problems. So the topics for today, we'll be looking at some of the recent messages from the FRC, and in terms of their thematic reviews and other guidance and areas of focus going forward. We'll also look at, as part of year-end reminders, what are the changes to standards and new requirements coming in for this reporting season, though fortunately there aren't too many of those this year. After that, we'll move on to consider Brexit and a few financial reporting implications from that, as well as climate change, which has now become really quite a key issue for all companies to be thinking about in this reporting season. So just before we get into the detail, the backdrop or the context for this reporting season is one where businesses are really facing a lot of uncertainty. It's been quite a year with COVID-19. We're seeing ongoing effects from the pandemic. Of course, nobody quite knows what hopefully the recovery period will look like. We're also dealing with Brexit. We still don't know what kind of, or whether there will be a trade deal, and businesses will see change from that, and as well as uncertainty. And we also have climate change, which has now become a sort of current agenda item, causing the potential for a lot of change and uncertainty for businesses again. So it's a time of a lot of change and a lot of uncertainty. And that's a theme that cuts across a lot of the topics and the guidance coming from the FRC as well. So it's very important for companies to explain in your accounts, in your annual report, what effects each of these key matters is having on your business, what effect it's had this year, and what change it could have on the prospects going forward. So that would feature for UK companies as part of your narrative reporting in the front end, explaining changes to risks, changes to business model and strategy, explaining then how those changes are taken into account, or making sure they're taken into account consistently in the accounting. So that means to say in the judgments, estimates, the assumptions that a company makes, which involve forward-looking information of what all of these different aspects and changes going forward, what they mean for your business, and therefore what that means for items in the accounts. So particularly many companies will be performing impairment reviews, need to consider valuations of various assets, potentially some provisions. So those are sort of themes that need to be considered for each of these areas: COVID, Brexit, climate change. Each of those matters has the potential to affect these parts of the accounts. Similarly, a few other items there on the screen. Of course, potentially going concern and viability could be affected for some companies by any of these matters, and there are many related disclosures relating to liquidity, cash flows, dividend policies, capital maintenance, which we would expect to be tailored to explain any changes. So bear in mind those areas and the importance of linkage and consistency in annual report as we run through the topics for today. So I should have said so far that I'm joined today by Robert Carter, and he's going to take us through the FRCs messages and the year-end reminders next.
Okay, thanks, Elisa. So as you'll be aware, the FRC usually releases a number of publications in the final quarter of the year, and this year has been no exception. So if we look onto the next slide, we'll see that we've summarised the different publications that have been released by the FRC over this last quarter. They're all available from the FRC's website, and we recommend that you have a read of these yourself. They're all quite accessible. The FRC first published COVID-19 related guidance back in February, and this obviously has been updated throughout the year as the pandemic kind of has moved on in progress. A consolidated version of the guidance was recently released 4th of December. A thematic review report was published back in July, setting out detailed guidance and examples on disclosures for the financial reporting effects of COVID-19. This is based on the Corporate Reporting Review Team, the CRRT's monitoring, and it's worth looking at when preparing your next reports. The FRC Lab has also provided some COVID-19 guidance throughout the year, starting with an infographic back in March, setting out 5 questions on information that investors are most interested in. In June, the FRC Lab then followed that up by issuing 2 reports under the theme of reporting in times of uncertainty, considering disclosures firstly about going concern, risk and viability, and then secondly about resources, action and the future. The lab's now also published a follow-up looking forward reports in October, and each of these highlight how reporting has evolved over the course of the pandemic, and also what's going to be the most useful going forward for you. Additionally, throughout the year, the FRC's produced a number of thematic review reports that focus on specific topics. So firstly, it had thematics on IFRS 15 and 16 disclosures. It also had one on cash flow and liquidity disclosures, and also its climate thematic. We'll cover the key points from these in the following slides, and the climate thematic, Elise is going to come back to a little bit later on in the webinar. The FRC Lab also published a set of tips in October aimed at helping companies consider the content to include in their Section 172 statement, how to present that, and the process for preparing the statement in the first place. Finally, the last thing we summarise on the slide is the review of corporate reporting, which sets out the FRC's findings from its review and monitoring work conducted throughout the year, and also then highlights the areas of improvement. This is also accompanied by a year-end open letter to audit committee chairs, CEOs and CFOs, setting out expectations for the next reporting season. And we'll look at those messages as well in a bit more detail shortly. Separately, there's also been a review of the corporate governance reporting in the first year of adoption of the 2018 FRC code, and we'll also have a little bit of a look at that. So if we dive into the detail on the next slide, you'll see the first area we looked at is the FRC's thematic review into IFRS 15. So in September, the FRC published its final thematic review on IFRS 15, revenue from contracts with customers. This was the second year of IFRS implementation for most IFRS preparers, and the review follows on from the first year thematic last year. But different companies were chosen, and also this year there was no bias towards kind of particular sectors. They just took a whole range of different sectors. The FRC focused as part of this on 6 aspects of the standard, which were areas that had caused concern previously, and these have been set out for you on the slide. The report and all of the different thematic reports that we're going to mention throughout this provide some really useful better practice example disclosures. So they're good to look at when you're preparing your own disclosures going forwards. So looking at the 6 areas they focused on, the first was the timing of revenue recognition. Now, it was not always clear what the performance obligations were or how they were being satisfied. So for obligations satisfied at a point in time, the FRC was concerned that disclosures should make sure that they specify when the control is transferred. And for obligations satisfied over time, it should be clear how the criteria were met, and the specific method that was used to measure progress should be disclosed as part of this. In terms of variable consideration, the FRC continues to challenge many companies' disclosures and accounting for variable consideration. Disclosures shouldn't just simply repeat the wording in the standard, but should rather explain how it's specifically applied for the company. It also needs to make sure that it identifies all the different types of variable consideration and how each is estimated and constrained. In terms of revenue disaggregation, the most common categories for disaggregation were geography and type of good or service. But the example categories that are listed in IFRS 15 are just examples. examples, and alternative categorizations may work better. The FRC was also keen to ensure that disclosures are consistent with those of disaggregation in the strategic report. The fourth area they focused on was related to contract balances. Now, the disclosures here should set out how contract balances arise, how contract assets are distinguished from receivables, and also show significant movements in the balances during the year. They also, in terms of contract balances, are keen for people to explain what other accrued or deferred income balances relate to. The fifth area that the IFRS 15 thematic focused on was significant judgments, and you'll see this as a key theme throughout all of the thematics. In terms of judgment disclosures, they shouldn't just state the judgments, but they should provide the thought process, for example, the reasons behind the principal versus agent assessment. If judgments also involve estimates, the quantitative information over estimation uncertainties is also required by IAS 1. And the final area that the IFRS 15 thematic picked out was related to costs to obtain or fulfill a contract. The FRC is concerned that companies may not have fully understood the requirements in this area, which mandate capitalisation of costs in some cases. The sectors of particular concern include construction, support services, and software. If capitalised costs are inapplicable or immaterial for a company, but it's typical for the industry that you operate in, the company should be making that clear in its disclosures. The next thematic review that was released was the thematic review covering IFRS 16. This was looking at the disclosures for IFRS 16 included in annual reports for a sample of listed companies in industries where the new standard was expected to have a significant effect, focusing on the accounting specifically and disclosure by lessees. The purpose of the review was kind of twofold. Firstly, to consider how effectively the companies have met the ongoing disclosure requirements of IFRS 16, as well as the adequacy of the transition disclosures relating to the adoption of the new standard. Most companies provided a good explanation in terms of the impact of adopting IFRS 16 in the first year of adoption. However, the quality of their disclosures should improve in future reporting. There was 3 specific areas for improvement that were identified that have been set out there on the slide. Firstly, in terms of accounting policies, as noted in the previous thematic reports on other topics, accounting policies should be tailored to an entity's specific circumstances, avoiding the use of kind of boilerplate language, and they should also make sure that they cover all material aspects of leases held by the entity. Better policies included clear entity-specific information about the ongoing application of the standard, such as explanations of whether or in what circumstances the rate implicit in the lease could be determined, and also situations where the rate implicit in the lease cannot be determined should also be clear. The method used to determine the incremental borrowing rate where this was used, including details of the inputs used and what the rate actually represents. And finally, the accounting treatment applied for things such as non-lease components and the threshold applied for low-value leases. The second area for improvement was related to significant judgments, again similar to IFRS 15. The most common judgments disclosed in the annual reports reviewed were in relation to the determination of the lease term, the exercise of lease extension or termination options in most cases. In a number of cases, the FRC found that other disclosures in the accounts indicated key judgments had been made in the application of IFRS 16, but these were not disclosed as key judgments in the accounts. The final area of focus covered disclosures. So the FRC found that few companies provided the broader information required by IFRS 16 paragraph 59 to help users understand the exposure to future cash flows from leases. So this could include, for example, the nature of variable lease payments or the impact of extension options not included in the lease liability. The FRC noted that most companies provided the quantitative disclosures that are required by paragraph 53 of IFRS 16, but often this was not in a single note as required by the standard. So moving on to the next slide, third thematic we're going to look at is the one that's been completed in relation to cash flow and liquidity disclosures. So the FRC has chosen this topic because it frequently finds basic errors when reviewing cash flow statements, the sort of errors that it can pick up just from a desktop review. In addition to cash flow statements and the supporting financial statements disclosures, the FRC was also considered strategic report disclosures on cash flows and liquidity risk disclosures in the context of going concern disclosures, as well as viability statements, because management of cash flows and liquid resources is obviously going to be critical to making these assessments. The report again includes many examples of better practice disclosures. In terms of some of the key points that they've highlighted, as you see on the slide, firstly, in terms of cash flow statements, companies should make sure that they focus more on avoiding basic errors and non-compliance with IAS 7 in terms of classification of cash flows, and also ensure that the amounts and descriptions relating to cash flow items are consistent between the cash flow statement and the supporting notes, including, for example, the reconciliation of financing activities, as well as other parts of the annual report, such as the strategic report. In terms of accounting policies for cash flow statements, policies and judgments related to cash flows should also be disclosed, especially for those large one-off transactions that might happen during a period. The second area covered related to going concern and viability. So companies should explain in detail what matters were considered as part of these assessments, including the availability of cash, undrawn borrowing facilities, and compliance with debt covenants. It also needs to clearly disclose the methods, assumptions, and judgments that have been applied as part of that assessment. And the third area related to IFRS 7 disclosures. So there's a number of specific suggestions included in the thematic, as well as expectations relating to the presentation of liquidity risk tables, debt covenant disclosures, and also supplier financing arrangements. Next slide, please, Elisa. The FRC's annual review of corporate reporting this year is a relatively shorter report compared to that you might have seen in recent years. We certainly think that it's quite accessible and provides a clear picture of the common errors and issues that the FRC is finding in the course of its monitoring work. It provides a good indication of the areas that the FRC is likely to focus on as well in the coming reporting season. In terms of what we've got here on the screen on the slide, you'll see these are the top 10 areas of findings where the FRC considers that improvements in disclosure are required. Judgments and estimates, as we've already mentioned, remains the single area where the most points are raised in line with recent years. As you can see, there's also been some movements in the other top 10 areas. This year's report also comes with a highlight summary, which sets out the key improvements expected for each of those areas listed on the slide. Apart from highlighting some specific disclosure requirements that are, in the FRC's view, being applied poorly, a key message from this year is that the FRC also expects companies to consider the more general disclosure objectives set out at the beginning of the disclosure sections for some of the more recent IFRSs that have been released, such as IFRS 9, 15 and 16, and also the general disclosure requirements set out in IFRS 1, paragraph 31. This means that after complying with the explicit disclosure requirements set out in the accounting standards, it's necessary to take a step back and consider whether the resulting disclosures are clear and provide the appropriate level of decision useful information. If the answer is no, then the additional disclosure should be considered in order to meet these general disclosure objectives. So it's not just applying the very specific definition disclosures required, it's taking that step back and thinking about the broader picture essentially. Next slide, please, Elisa. So as I mentioned earlier on, after publishing its annual review of corporate reporting, the FRC also published an open letter which is addressed to audit committee chairs, CEOs and CFOs, highlighting the key areas of focus for the next reporting season. So this year's letter included a summary of findings and expectations from each of the thematic reviews that I've mentioned, as well as other guidance that the FRC has published throughout the year. Obviously, we've already talked about the thematics, but on this slide, we've just included some of the key points mentioned in related to COVID-19, Brexit, and also Section 172 statements. The COVID-19 points are in line with the guidance that's been issued by the FRC earlier in the year, and these are covered in more detail in some of the earlier webinars, which you can listen back to. All of this obviously continues to be very relevant for many companies at the 31st of December reporting date. And the key messages are to focus obviously on disclosing entity-specific information that's consistent across all of the reporting in the annual report. For Brexit, which we'll come back to in a little bit more detail in a moment when we move on to Elisa, the FRC obviously reminded companies to disclose the entity-specific risks and uncertainties, specifying which parts of the business are affected and the amounts involved. Finally, on the slide, for Section 172 statements, which was a new requirement for last year's December year-end reporters, the FRC highlighted points from the FRC Labs tips document, which was produced after that first year of implementation. The FRC reminded companies to focus on explaining fully how directors have discharged their Section 172 duty to consider broader factors, and in particular to explain the long-term consequences and decisions and how those have been considered. In terms of stakeholder engagement, disclosures both positive disclosure should include both positive and negative feedback from the engagement with stakeholders, and also crucially how that affected the decision making as well. They also stress that companies should not treat the Section 172 statement as a kind of tick box compliant exercise. So the final area in terms of FRC reviews, just to look at, if we can go on to the next slide, please, Elisa, is that the FRCs also released a report covering a review of the corporate governance reporting, considering the first year of disclosures under the new 2018 UK Corporate Governance Code. Overall, the FRC considers that the quality of reporting under the revised code is a mixed picture. The code was revised to emphasise the wider benefits of good governance for the economy and society. It calls on companies to establish a purpose which is aligned with its culture and strategy, and to forge strong relationships with key stakeholders. Although reporting on stakeholder engagement has improved, the FRC is concerned that some of the companies it reviewed continue to rely on the reporting process rather than necessarily the substance behind the code. The review highlights the need to demonstrate consideration of feedback to the board and outcomes, such as the influence on decision making, which we talked about a second ago in terms of Section 172 as well. The FRC expects improvement in a number of areas, which we've summarised on the slide. So these include companies should provide clear and meaningful explanations of how they achieve good governance standards in line with the flexibility offered by the code. They should clearly show the impact of engagement with stakeholders, including shareholders and the workforce, on decision-making, strategy, and long-term success. They should include better assessment and monitoring of culture, including consideration of methods and metrics used. And finally, they should be demonstrating commitment to diversity, inclusion through actions such as improved succession planning and the recruitment from diverse talent pools. So that brings us to an end in terms of the FRC publications that have come out this quarter. We're also now going to provide a summary of the other year-end reminders about the new requirements that are applicable this year. After all of the major IFRS standards that have been released in recent years, I think we'll all be pleased to know that there are no new standards to be implemented this year or in the near future, with the exception, I guess, of IFRS 17, the insurance contract standards. However, there have been some changes to IFRS standards and also some changes to narrative reporting required under the Companies Act, which were summarised on the slide here. We've discussed each of these different amendments to the IFRS standards in our previous webinars, mostly back in the June 2020 webinar. So we're not going to go back over the details of those again, but just highlighting them as a reminder that this is going to be the first time these are going to be implemented. The amendments to IFRS 16 is just one that I'll pick out there. So the amendments to IFRS 16 for COVID-19 related rent concessions are effective from the 1st of June 2020, but earlier application is permitted and many entities are expected to adopt these in their December 2020 year-end accounts. The details of these amendments were again discussed in our September webinar, but just to note they have now been endorsed by the EU and so are available for use by companies, which they hadn't been at the time that we did that, made that recording. In addition to the IFRS amendments, you'll also see on the right-hand side of the slide, there are some Companies Act changes which are likely to be applicable for the first time for December 2020 year-end reporters. So the first we picked out is the Streamlined Energy and Carbon Reporting, or SECA requirements, that are applicable for all large companies with periods beginning on or after the 1st of April 2019. And so 2020 is likely to be the first time that December year-end reporters apply these new requirements. We've again covered detail both on the scoping and requirements of SECA back in our April webinar. Note that there are additional disclosures here also for quoted companies that were previously within the scope of the greenhouse gas emission disclosures, so you can't just carry on necessarily as you were. The scoping of these requirements can be tricky, and so it's worth making sure that you've had a look at it in good time, and certainly for some of the reporters who have got year ends earlier on in the year, we've already had quite a number of questions coming in. The second change that's going to be relevant this year applies to those entities that are within scope of the Directors' remuneration reports under Schedule 8, i.e. quoted and traded companies. So there have been a number of amendments to these regulations over the past years with different implementation dates resulting in changes to remuneration policy requirements as well as the remuneration report disclosures itself. All of the updated requirements should now be applicable for December 2020 year ends. Again, we've covered details of the scoping and the requirements of these in previous webinars, but just highlighting them to you as a reminder, this is going to be the first time you're applying some of these. Moving on to the next slide, here we've summarised the standards and amendments that are not yet issued, or that are issued but are not yet effective. So these are the ones which you may need to disclose in this year's financial statements, or consider early adopting, subject to EU or UK endorsement. IFRS 17 is of course a very significant change for effective entities, and this will take some time to be endorsed, so it's not yet available for early adoption. Note that EU endorsement is still outstanding for all of the amendments that are mentioned on the slide. For UK companies, if this is not completed by the end of the current year, being the transitional period for Brexit, then they will need to be endorsed by the new UK Endorsement Board. Preparations are underway for that process to happen, including specifically, I'll highlight there the phase 2 IBOR amendments, which are expected to be endorsed probably early in 2021. We're going to come back onto the UK endorsement process in our Brexit session in a little while. In addition to changes to IFRS, just to highlight for our UK GAAP reporters, there have been a number of amendments to UK GAAP coming out, particularly in the last quarter of the year. So the first is an amendment relating to FRS 101. This essentially is a tidying up exercise following the ISB's deferral of the effective date for IFRS 17. You may remember that the FRC amended the definition of qualifying entity back in 2019 so that insurers would no longer be able to apply FRS 101. The reason behind this change is that IFRS 17 is currently inconsistent with UK company law, and so it wouldn't be able to be applied for UK GAAP Companies Act accounts. The change in definition was aligned to the effective date of IFRS 17, which has now been delayed further to the periods beginning on or after the 1st of January 2023. And so the FRC has therefore just amended FRS 101 to allow insurers to continue to apply FRS 101 until the now delayed effective date of IFRS 17. The second amendment you've got there highlighted on the slide relates to FRS 104 and interim reports. FRS 104 did not previously contain any requirements that explicitly covered the assessment and reporting on the going concern basis of accounting. However, an entity was required to state that the same accounting policies applied compared with the most recent annual financial statements, which would have included any statement about going concern basis of accounting. So the amendment just introduces some requirements covering going concern in a similar way to IS 34 does for IFRS reporters. Finally, with the greatest significance is the amendments to FRS 102 and FRS 105 with respect to COVID-19 related rent concessions. This is immediately effective for periods beginning on or after the 1st of January 2020, and we'll go into a little bit more detail of this on the next slide. Looking at the detail of the COVID-related rent concessions, the first thing to note is that while this may look very similar to the IFRS 16 amendments, there are some key differences in the detail. First of all, these amendments to UK GAAP apply to operating leases of both lessees and lessors. The amendments do not cover finance leases. The existing requirements of FRS 102 must be applied to leases that are classified as finance leases. Second, similarly to IFRS 16, there are 3 criteria that must be met. These are again similar but not the same as the IFRS requirements in all cases. So the first one is about the change in lease payments must result in revised consideration for the lease that is less than the consideration for the lease immediately preceding the change. This means that concessions that provide a rent deferral are not captured because the total consideration is overall unchanged. By comparison, some rent deferrals would be captured by the IFRS 16 amendments. Secondly, any reduction in lease payments must only affect payments originally due on or before the 30th of June 2021. And thirdly, there must be no significant change to other terms and conditions of the lease. So there's no further guidance, unfortunately, on what significant change means. But things like extending the terms of the lease or introducing new break clauses or extension options is likely to be considered significant in this regard. If these criteria are met, the change in lease payments or income for lessors must be recognised over the period that the change is intended to compensate. So to give an example, if a lessee benefits from a rent holiday in April 2020, it would recognise no expense for that particular month. Finally, the amendments also introduce a specific disclosure requirement for lessees in relation to the change in lease payments related to COVID-19. There's no additional disclosure requirements for lessors, as the information about rent concessions is considered to be captured as part of the existing general disclosure requirement to provide information about significant leases. Just to reiterate again, the amendments for this are effective for periods beginning on or after the 1st of January 2020 with earlier application available. The final thing just to highlight in terms of our year-end reminders is just that we have got updated illustrative IFRS financial statements for the for 31st December 2020 year ends. These are available from the BDO UK website as well as the BDO Global IFRS site. There's also been a range of publications that we've released throughout the year on specific topics, including COVID-19 implications on accounting and reporting. And these again are available through the COVID-19 hub of the BDO UK website, along with the BDO Global IFRS microsite. I'm going to hand back over to Lisa now, who's going to take you through Brexit and the financial reporting implications.
All right, thank you very much, Robert. I hope everyone can hear me. So what we'll now do is talk a little bit about the financial reporting implications of Brexit and after that, climate change. So I am absolutely certain that you are all perfectly aware that the UK did leave the European Union earlier this year, and that we are have been in the transition period. And this transition period, of course, is now coming to an end at the end of this year. So, of course, UK businesses are needing to think about and make plans for the changes that will take place at that time. And there will be changes. There will be changes to the way different businesses do business in Europe. Things that will affect sale of goods, imports, exports, providing services, tariffs, data regulations, how we travel, how we hire people, things like that. Now, these will be very entity specific in terms of what they mean for each company. That does mean that these changes have the potential to have all kinds of financial reporting effects, and every company will need to think about how your cash flows, how your operations are affected, how that may affect your cash flows, and consequently what that might mean in the accounts in terms of carrying values of assets and liabilities. So I think we're not going to go into more detail on those accounting effects, but there potentially will be many of those for companies whose businesses are heavily affected by Brexit. Meanwhile, there are also a number of regulatory changes. So we will see a change to the accounting framework in the UK. There are some changes to regulatory provisions affecting things like exemptions, and we may see some tax changes. So those are the matters that we're going to talk about. And let's just firstly, I want to emphasize that the Brexit transition period actually ends at 11 o'clock on the 23rd of December this year. So that's worth bearing in mind, because what it means is that Brexit is an in-year event rather than a post-balance sheet event for 31st of December 2020 reporters. There could, for example, be some tax implications that will actually need to be accounted for from that time, even though it's 11 o'clock. So let's look at the accounting framework first of all. So at the moment, so companies will need to figure out which accounting standards are you applying and disclose that correctly in the basis of preparation note in the accounts. So at the moment, companies in the UK applying IFRS apply EU adopted IFRSs, and that has remained the case for the Brexit transition period. Now, that will change once we get to the end of the transition period, and from 1st of January 2021 onwards, we'll be applying instead UK IFRSs. So UK adopted international accounting standards. And how that works is that basically the body of IFRS that we have endorsed by the European Union gets frozen at 11 o'clock on the 31st of December 2020. And from there onwards, we take it forward with our own UK endorsement process. There'll be a UK endorsement board that's already been set up with a chair and a secretariat, and they are currently selecting the members, and once that's done they'll be able to endorse IFRSs in the UK. We expect that to be fully in place and working early in the new year, and if there is a standard that needs endorsing before that, then the Secretary of State currently has, or from 1st of January, has the power to do that. Now this does present a slight or there's one more thing to think about, which is for periods that are crossing over the 31st of December 2020. So accounting periods that began before the 31st of December 2020 and where either the accounting period is crossing over or the accounts have not yet been filed. So anyone in that situation it's slightly unusual. You apply EU IFRSs as at 11 o'clock on the 31st of December, plus you can also adopt any UK endorsed IFRSs after that time. So that could be applicable, for instance, with the phase 2 IBOR amendments that we've talked about, which some of you might be looking to adopt sort of as soon as they're available to avoid any complications for financial instruments accounting as a result of IBOR reform. Okay, then next, some changes to specific regulatory provisions relevant to financial statements. So first of all, if any companies have shares or debt listed on an EU regulated market, you'll need to be quite careful and probably take some local advice to make sure that your accounts are prepared under an acceptable accounting framework for that exchange, for that market. So UKGAP accounts might not work anymore for that purpose. Maybe UK endorsed IFRSs might, but you'll need to be careful with that. And also make sure you're applying the correct version of the what we have in the UK, the DTR, the Disclosure Guidance and Transparency Rules. That's the UK version, and that applies to companies, continues to apply to companies listed on UK regulated markets. But now for European ones, you'll need to refer to the version applicable in that jurisdiction. For periods that begin after 1st of January 2021, there could be a number of exemptions that are no longer available. So this list here is not necessarily comprehensive, but here are some examples of ones that depend on having a European parent. Those exemptions are not going to be available in the same way anymore. So for example, a consolidation exemption if you have a European parent under section 400 will now only apply to UK parents. You may be able to get an exemption under section 401, but that's a slightly different one and depends on which GAAP that European parent is using in its accounts. So IFRS will probably be fine, but a local European set of accounts might not. A few others there: non-financial reporting statements, changing your accounting reference period, audit exemption due to parental guarantee. These fall away to the extent you were depending on an EU parent for them. Also, dormant subsidiaries of an EU parent no longer be able to take advantage of the exemption to prepare and file accounts. So they'll need to start preparing and filing some accounts. All right, in terms of where should you look for more guidance, the government website, BEIS, has released quite a lot of material in the last couple of months, including some both industry specific and general webinars. There's an open letter from the FRC and BEIS, which explains some of those exemptions I was just talking about in detail. And we do also have a lot of information on our BDO UK website, including on matters such as we have a sort of microsite there for Brexit, and that has quite a lot of information and webinars as well on topics like tax, VAT, customs, employment matters. So do take a look at those. Just a word on tax. Now, every company's tax circumstances can be quite individual, so we're not able to generalize in terms of what might change for you as a result of Brexit. But do take note that if anything is changing with your tax status, then that happens at the time of leaving the EU, so at 11 o'clock on the 31st of December, and there could be accounting effects of that in the current year accounts. One area to look into might be withholding taxes. If you've got unremitted earnings from subsidiaries, you may need deferred tax accounting for those. If that's in a country that may now be imposing withholding taxes, whereas previously that wouldn't have been the case under the EU rules. So it's best to seek specific advice on the tax, but do note that that could have accounting and deferred tax accounting effects as well. Right, so now let's talk a little bit about climate change. So this has not suddenly, it's been developing as a significant agenda topic in recent years, and I'm sure you've all noticed that there's something about climate-related matters in news all the time, almost every day. So it's high on the agenda for governments, investors, lenders, regulators, and society in general. We've got net zero targets by governments and many companies as well. And essentially most businesses will be affected by climate change in some way or another in the coming years, whether that's as a result of those physical risks to do with the weather patterns changing, or more indirectly transition risks that happen because of the regulatory changes and changes in consumer demand and things like that might affect business models. So as a result of that, investors really are asking companies to disclose more information about the effects of climate change on the company and the effect that the company has as well on the environment, so that they can take that into account in making their investment decisions. And what this has caused is that a number of okay, so firstly, we do have a number of existing financial reporting requirements that I'll just touch on briefly in a moment that companies need to be complying with. But in addition, a number of voluntary initiatives and reporting frameworks have developed in recent years. There are many of them. There is, you might have heard of TCFD, CDP, SASB. There are all many different options out there for companies to report further information, which has become potentially a little bit confusing. So what's happening now is we're starting to see a trend towards hopefully a more consistent and global approach to reporting in this area. So we expect this to be something that's going to develop in the near future, and something that companies will need to put some time into developing appropriate reporting on. In the meantime, the FRC has recently published a very comprehensive review of climate-related disclosure and reporting in the UK. And they did this in a slightly new way by looking not just at what companies are how companies are accounting and disclosing things in annual reports, but they looked at sort of all the parties who are responsible. So boards have responsibility to consider the climate and take that into account in their governance and business models and strategy. And also, you know, companies have a role to play in how they report this information in an annual report. Auditors have a role to play in challenging and considering these risks as part of an audit. Those institutes, professional bodies have a role to play with training and monitoring. And investors are very much interested in what companies are reporting, but also have their own reporting obligations and changes to look at. So how this works is there's a summary report and 5 separate reports that look at each of those targets and emphasizing that everyone has a role to play to drive change in this area, and more is expected from all of us. So just looking in slightly more detail at the corporate reporting report, which was published addressed at companies in particular. This report sets out some specific expectations based on the current requirements that are in place for UK companies for financial statements and narrative reporting. So this is a very detailed report, which we would recommend that you take a look at. And it does have a summary, 2 pages approximately, of what the FRC expects to see. And some of the key points they made is to remind companies to report both on the effects of climate change on the company, as well as the company's effect on the environment. Both of those are important and are reflected in different requirements. So we've got things like the streamlined energy and carbon reporting requirements about the effects that the company has, as well as non-financial information statements about those effects, and additionally on the effect that climate has on the company. We would expect that to be reported as part of business model and strategy reporting, principal risks and uncertainties, and viability statements, and going forward some potentially additional reporting under, say, the TCFD framework, which I'll mention in a moment. But one key point is that it's really important that if a company is identifying risks to their business model and making changes to their strategy, then those considerations need to be consistently reflected in the accounting. So that means in the carrying values of assets and in the judgments and estimates that are made in the financial statements. And in this area, we've now recently had additional guidance from the IASB for IFRS reporters. The same considerations really would apply to UKGAP reporters on the whole as well. And this consists of an article in November last year, as well as an additional form of educational guidance issued in just recently, a few weeks ago. And what these 2 pieces of guidance do is summarize how current IFRS requirements may be asking companies to consider climate-related matters. So they run through the standards that have requirements that could be relevant. So for example, IS 36 on impairment, some of the developments in the industry you're part of, the regulatory environment, could mean that you've got an indicator of an impairment and that you may need to consider your actual impairment calculations. Could be that you've got asset lives that need to be reconsidered in terms of the depreciation rates. It could be that you have provisions to be made for perhaps penalties and fines. And this guidance runs through all of the standards. It also talks about how you make materiality judgments in this context, and reminds companies that sometimes information can be material to disclose because it's qualitatively important. So for example, if your investors are really interested in how your business is going to address climate related matters going forward, then that information could be material P&L, even if you haven't actually booked a material impairment charge in the year. You might need to explain in your accounts why that was and how did you consider this issue. So this is an area where reporting will need to evolve, and we probably will be seeing some additional requirements coming through. There has been a consultation from the IFRS Foundation. They're the body that sits above the ISB, the standard setters there, to propose setting up a separate sustainability reporting standards board to set global standards in this area. That proposal's been widely supported, including by UK bodies. The FRC supports that, the Developing Global Standards, but additionally the FRC has meanwhile requested UK public interest entities to voluntarily report under what's called the TCFD framework. So that's the Task Force on Climate-Related Financial Disclosures, as well as some sector-specific metrics to disclose some specific effects under what's called the Sustainability Accounting Standards Board's sector-specific metrics. So that's what the FRC is recommending at the moment. And in fact, the UK government has also announced some policy objectives and even an indicative roadmap whereby they intend to mandate this type of reporting across the UK economy in the coming years, so by 2025. So I think we can expect to see some consultations on those matters. And in the first instance, earlier this year, the FCA already consulted on a new proposed listing rule for premium listed commercial issuers, which we expect to be issued and effective from 1st of January 2021, requiring those companies to report under the TCFD framework. This will be on a comply or explain basis. So if for some reason a company is not able to do that, they can explain why. We won't go into the detail on the TCFD today, but I'll just put it up there to give you a bit of an idea of what this is about. So it's a framework whereby companies would explain how they've considered climate-related matters as part of their governance strategy, risk management, and what kind of metrics and targets they're using to monitor this issue. So something to think about and start familiarizing yourself with. So that does bring us to the end of our updates today. I'm just going to pause and have a look to see if there are any questions that need to be answered right now.
No, Lisa, no questions left to cover at the moment. There's
okay. All right. Okay. So with that, thank you very much for joining us. Somebody did ask about a recording of the webinars. I think earlier I saw that. So that will be available if later on. And thank you.